this is ACC Amit Kumar and we'll discuss IFRS 16 leases. So IFRS 16 leases is the new standard which got applicable from 1st January 2019. In India, it is applicable from 1st April 2019. Why this standard was introduced? This standard was introduced because there was a lot of confusion between deciding whether the arrangement is an operating lease or a finance lease, and for that there was an interpretation issued as well, IFRIC 4, arrangements containing a lease, which required a lot of interpretation in terms of who is actually receiving the benefits, who is actually owning the asset, who will receive the benefits out of it. So, and mainly the aeroplane companies were taking advantage of it. They were not recording it as a finance lease. One of the company was selling an asset, selling an aeroplane, and they were recording sale of asset. They were recording it as part of their revenue. They were deducting it from their inventories. So the asset was removed from their balance sheet in the form of sale, that they have sold the asset. The other party which is receiving the asset, their payment arrangements were such that they were able to show it as part of their operating lease. They were not showing it as part of their finance lease, that they own this asset in terms of finance lease, and they do not show it as part of their asset category, and they were classifying it as operating lease because of some loopholes in the previous standard. So the aeroplane, which was not in the balance sheet of the selling company, which was not in the balance sheet of the buying company, where it was actually, so where is the aeroplane? None of them is recording. One of them is not recording it as part of the balance sheet. One of them is not recording, the party receiving the aeroplane is not recording it as part of their own balance sheet. The aeroplane was actually in the air. So this loophole is being amended. Like earlier, IAS 17 was the standard which was dealing with leases. So IAS 17 was the standard which was dealing for leases for both lessors and lessee and lessor. We were dividing the lease into two components: operating lease and finance lease. Operating lease means we are taking some property, plant and machinery on rent, and we were making a fixed payment over a period of time. We were using this and handing over the property or machinery back to the lessor at the end of the lease term. But if we were ambitious enough that we felt that we'll not only be able to make the capital repayment, but we'll also be able to make the interest repayment, and we could buy the asset on a finance lease. So the lessee used to enter into a finance lease wherein they were becoming the owner of an asset, but in terms of installments. So this was not being received on rent. This was being received in the form of an asset in the balance sheet, but a corresponding liability, because we were not paying immediately. We were paying in installments. So this resulted in an asset as well as and a corresponding liability in the balance sheet. Operating lease was simply an expense in P&L account. They're simply recording it as an expense as part of their operating lease expense in P&L account, was hitting directly the P&L account. Nothing was coming onto the balance sheet for a lessee. Lessor, if they enter into an operating lease, they were recording simply an income in P&L for handing over this asset on lease to someone. And if they had entered into a finance lease, they were supposed to de-recognize the asset, and replace it with lease receivables, because they were supposed to receive an amount against it. The asset was knocked off from the balance sheet of a finance lease of a lessor because they are actually giving away the asset on finance lease to some other party. The party which is owning this asset through this finance lease will be recognizing this as an asset. The party which is giving away this asset will de-recognize the asset and will replace it with lease receivables. So they'll be receiving only fixed amount over a period of time. Now, as far as IFRS 16 is concerned, lessor accounting, there is no change. The only big change is in terms of lessee accounting. With the introduction of IFRS 16 leases, lessee accounting is changing. Lessee accounting is changing with the introduction of IFRS 16 leases. There's no change in lesser accounting. The lesser accounting continues to be remain the same. They still classify an asset into an operating lease or finance lease. They'll record it income if it is an operating lease. They'll record it derecognize the asset. Will record lease receivables if it is a finance lease. There's no change as far as lesser accounting is concerned. Lessee accounting, what is the change? The operating lease or finance lease classification will be a thing of the past. There's only one criteria which will remain, and that is a new term is coined or a new term is introduced for both operating leases or finance lease. It is known as rights of use. In short form, we can call it right of ROU. Right of use is being introduced. Earlier, operating leases were off balance sheet items. They were off balance sheet item. And finance leases were on balance sheet. Now, since there is no more classification between operating and finance in terms of lessee, all the leasing arrangements will be onto the balance sheet in the form of rights of use, on balance sheet item. No concept of operating or finance lease, right of use. When I bring something as right of use and I also agree to a installment payment over a period of time. Now, whether it is an operating lease or finance lease, there is no classification. It's simply that I bought an asset, I have right of use for a certain period of time, and for using this asset, I'm liable to pay. Whatever is the lease liability will be forming as part of the balance sheet on the corresponding side. Now, for being able to use this asset, there is a corresponding liability agreed on the same date at the inception of the lease. Now, all the lease arrangements will have this feature of an asset on one side and a liability on the other side. Now, this lease liability may be different, may not be equal, because to get this right of use, the party may pay. To get this right of use, the party may pay in terms of cash. There may be some directly attributable costs which are paid, again some payment in cash. So there may be direct payment of cash, there may be some directly attributable costs which are paid for entering into this lease. And then there is present value of minimum lease payments. Whatever you decide to pay over a period of time. Now this is these are the installments discounted in today's value. Now your right of use asset may be a bigger amount in comparison to your lease liability. Earlier, the finance lease was equivalent to the liability, but there is no such thing now, because right of use may be a combination of your cash payment, maybe a combination of a directly attributable cost, maybe there may be some present value of minimum lease payments, the installments you have agreed. So all these payments together will constitute the right of use on the asset side, and in the corresponding liability side there will be only one line, the present value of minimum lease payments out of these. So it's not necessary that these two amounts are going to be the same in future. It's not at all necessary that these two amounts are going to be the same. And this is being done on accrual basis. You can pick up an example from the book. When it's talking about lease liability, in terms of lease liability, it can be present value of lease payments. There can be other items as well, like variable payments which have been agreed, which may be dependent on some index or a rate, dependent on index or a rate. There may be some guaranteed residual value payments, guaranteed residual value payments. There may be a purchase option if it is certain to exercise. Purchase options. These all may also result in increase in the value of liability which we have to record. So depending on whatever the situation, if they constitute, so guaranteed residual value payments are that if we use your asset, we believe that we'll maintain your asset in such a manner that you will be at least be able to get in terms of residual value this amount. So the lessor says that what if I don't get this amount? Suppose we guarantee a residual value of 200,000, and if the lessor doesn't get that 200,000 in the market, the lessee pays for the difference that we guarantee you. So there may be guaranteed residual value payments as well that will maintain it in such a manner that you will be at least able to get 200,000 in the market. But what if they don't get? The shortfall is paid by the lessee. So on the basis of the expectation, we may also need to record these guaranteed value payments. Purchase options, if we are certain that we are going to own that asset after the end of the lease term, we are going to own that asset. There will be a liability in the terms of if there is a certainty of purchase, we are also required to include these purchase options amount as well, because we believe that we are going to own this asset at the end of the lease term. So here's an example wherein a lessee enters into a 5 lessee enters into a 5-year lease, no transfer of asset at the end of lease term, no purchase option, so no liability in terms of any variable payments in terms of purchase options. Useful life is 10 years. It is agreed that there will be payment of 50,000 per annum at the beginning of each year. So when this lease is being decided, there is a payment at the beginning of each year. So first payment is in the form of 50,000 at the beginning of each year, means first payment is at the beginning, that is 50,000 being paid at the beginning, and 50,000 at the beginning of each year will be paid for each consecutive 5 years. Initial direct costs are 20,000. There is a lease incentive of 5,000. So what will be the impact of lease incentive? What will be the impact of lease incentive? Will it reduce my cost? It will reduce the liability. It will also reduce the right of use asset. Lease incentive of 5,000 will reduce the right of use asset. Cash directly attributable costs which are paid, it gets reduced by the lease incentive, as well as the lease liability also reduces by the same amount. So what will be the entry? What is the total value of right of use asset? Total value of right of use asset is any cash payment made. How much cash payment made? 50,000. 20,000 in the form of directly attributable cost, but there is a lease incentive of 5,000. So this 20,000 will reduce by this 5,000 less incentive 5,000. And what is the present value of minimum lease payments? There is a 50,000 payment over a period of time. So how to calculate the present value of all these years? 50,000 at the beginning of the year. Today it is 50,000. 50,000 at the end of 1 year or the beginning of second year, it turns out to be 1 divided by 1.05. 50,000 at the end of second year. Five installments. So we made a cash payment today of 50,000. Present value of minimum lease payments, when I discount to present value, means this 50,000 I'll not be including in it, because this I've already included as part of the total lease liability which I'm liable to pay, which the entity is liable to pay over a period of 4 years beginning next year is actually 177,297. This cash payment is already paid, so this is not a liability of future. This is already paid. Though the total payment against this is 177 plus 50, the total payment is this. But our present value of lease liability on the other side will only be 177,297 because that is liable to be paid after 1 year. We have already paid 50,000 out of it. There is no variable payment. There is no guaranteed residual value payment. There is no purchase option. So if I calculate, so what is the value of the right of use in total? Present value of minimum lease payments plus 50 plus 20 minus 5. Right of use asset lease liability will be equivalent to this amount, which will be forming part of the balance sheet, 177,297. Right of use will be a combination of cash plus direct asset minus lease incentive 5,000 plus the present value of minimum lease payments. This is the total value of right of use asset to be shown in the balance sheet. I can show it here as well. Cash, direct initial costs, incentives, present value of minimum lease payments. Initial direct cash is 50,000. What will be the entry for it? 20,000 minus 5. Present value of minimum lease payments is equivalent to 177,297. What will be the journal entry for this? For recording a right of use asset, there is a cash payment, cash credited. This is also gone out in the form of cash, 20 reduced by 5. Present value of minimum lease payments, again a credit balance of 17729. So if we are recording a debit of this, we are recording a credit of present value of lease payments, credit and debit. Is this clear? Hello, is this clear? Any doubt in this? So this is more or less similar to what we have been doing. The only difference is now that the right of use asset is a broader term now. It is a combination of both operating and finance lease. There is no further classification now. But whatever payments we are making will be forming part of right of use asset. What we have not paid will be forming part of the lease liability.
Amit, Bhanu here.
Yes,
I have just one thing. This is lease incentives. What sort of things can be included into lease incentives? Is this the residual value of the assets or?
Lease incentives are actually the incentives which are offered by companies to occupy the space initially. So they may give initial rent-free period, or if it is an operating lease, they may give an initial rent-free period that will allow you to operate initially for free for 2 months or 3 months. That can be an incentive. Sometimes they say that we'll give you a discount if you join us early, before Diwali, before Holi, or before some festival. We'll be able to offer you a discount. So when they are ready to offer us a discount, the amount being paid in the form of right of use reduces. So what is right of use? That I'm spending 242,297 to get the right of use asset for a period of time. If I get the same right at 230,000, I'll be recording 230,000 in my books. Because I got an incentive of 12,000, the same right of use I'm getting at a price of 230 now. So I'll be recording 230 as right of use. 230 will be amortized. Now this right of use is going to be amortized over the useful life. Now how much is the useful life? The useful life is 5 years. Now this amount, whether it is 242 or whether it is 230 or whether it is 220, incentive means the total amount which we have invested to get this right. It's kind of an investment. Like if we are purchasing an asset, we pay out money outrightly. Now we are purchasing an asset indirectly in the form of buying the right of use. We are not buying the asset, we are buying the right of use. The cost of buying that right of use is costing us 242. In that process, though we were supposed to pay, we got an incentive because of some arrangement. We entered into this booking early, or we entered into at a specified offer given by the company who is giving these rights of use. So we availed that and we could reduce our cost of investment in this right of use. Is this clear, Bhanu?
Yeah, thank you.
So view it as an asset which we are investing to use it over a period of time. Now useful life is 5 years. We are going to amortize this over a period of 5 years. This will be amortized. This will be unwinded. The lease liability will be unwinding of discount at the end of each year, and will be reduced by the payments at the end of each year. Because 50,000 payment is going to happen at the end of each year. So how this movement will happen? The lease liability opening balance is 177,297.5 is the opening balance. There's an interest charge of 5% on it. Now this is at the beginning on the inception. There's a early repayment, 50,000 at the beginning of the year. On it, there will be an interest component of 5%, which will be shown as finance charge. Into 5%, the total balance will be, which becomes the opening balance. At the previous year, 50,000 they again pay. This is, we have taken this amount at a discount of 177. If you were wanting at beginning of year, then 177,297. So finally, this becomes the opening balance. 50,000 payment made at the beginning of that year, and it gets settled. So this present value of lease liability is at the inception of the lease. After 1 year, this will be added as part of the interest cost. So this is the total liability against it, like total payment to be made against these lease terms is 227. We made at the beginning of the year, immediately at the beginning of the year, 50,000. So this is also the initial payment. This 50,000 is also the initial payment. If I begin calculation from 177, on it there will be interest charge for the year, because this is the amount which is included in the balance sheet without interest discounted to present value, the value today, the present value today. But at the end of 1 year, this will be subject to interest charge of 5%. So if I take this amount of 177, if I do not include this 50,000 initial payment, so this is already made at the initial inception, but the total liability is 227. The total liability is 227, which is to be reduced over a period of 5 years to 0. So if I take the total liability, I have to begin it by reducing 50,000 at the beginning of the year. But if I take only the present value of the lease liability for calculating the interest lease, this is the liability which is to be recorded. The interest component on it will be 5%. Interest component. So this is the area which people normally make mistake, and this is the area we need to be careful about, whether on what amount we'll be charging the interest charge for the year. So interest charge is simply a matter of being careful. Like I did the mistake here. Payment will be now the interest charge, adding the interest charge by the end of the year, it will be plus this. So this will be the balance at the end of the year, but this balance at the end of the year will be reduced by the payment made at the beginning of next year. Payment made at the beginning of next year. $50,000. So balance at the beginning will be 186 minus this 50, because there is a payment made of 8865. So this balance will be 142 minus 50, the balance at the beginning of the year, interest charge for the year, the balance at the end of the year, 50 minus 50, interest charge for the year, total balance 50, and payment made at the beginning of next year 50. This gets settled. So calculation is your choice, like depending on, just be careful that on what amount the interest is going to be charged, and when it is going to get reduced, what is the balance at the end of the year, what is the balance at the opening date. The balance at the opening date will be subject to interest components. These are the balances at the opening date, because they will be bearing the interest for the entire year. So simply a matter of, mathematics is a choice, as I always say that in accounting, don't get confused with mathematics. Mathematics is simply a matter of choice and matter of practice. Like the more we practice, the more we'll be good at mathematics. And mathematics is a choice. It's one and the same thing. I do it in this manner, or I simply begin by 177 and charge interest component, reduce it, or I begin with 227. I think this is better way of doing it. The total liability, though we have initially made the payment, we can begin from here, instead of including this, that our liability begins from here, 177 interest charge, balance at the end of the year. This became the opening balance. On the same date, there is a payment of 50,000. And the balance at the beginning is, these are the balances at beginning of the year. Interest charge for the year, balances at the beginning of the year, the total liability balance on the inception, and this is the balance at the end. On the asset side, we'll simply amortize this asset which is valued at right of use, asset which is valued at 240 to 297. Year end amortization will be simply amortization for the year will be charged at the rate of 242 by 5. This is how we'll be treating right of use on the asset side and the lease liability on the credit side. Any doubt in this? Hello. Now, when we enter into a lease, like for right of use, as in stressing on the point that right of use is an asset, right of use is a right to control. So right of use is actually right of use is right to control. And when you are able to write, when you have the right to control, when you can direct the use of the asset, and you're going to receive substantially all of the economic benefits, substantially all of the economic benefits. So give a simple example in this, that if there's a bottle of water, and there's a confusion among people that now, will there be two companies who are recording the same asset as part of the books? Yes. One party which is owning the asset for 20 years, they've given this right of use. So there is a Alpha is owning a machine, useful life 20 years. They give away this asset to Beta for use for 5 years. They will continue to record the asset as part of their books because they are indirectly a lessor, or they are owners of an asset. They'll continue to record that asset as part of lessor or owner of the asset because they are going to own it for 20 years. They will record it in the form of rights of use. Both the parties will record it as part of their asset side, but they will be owning this for a 20-year period, and they'll be owning this for a 5-year period. Right? It's like a bottle of water. Out of 20-year period, whoever is getting the benefit for 5 years will record the benefit of 5 years. The whoever is getting benefit for 15 years will record the benefit of 50 years. These 5 years, they may replace it with lease receivables depending on what kind of lease it is, whether operating or finance lease, what kind of lease they've entered into for 5. Normally, out of 25 is the period this will be an operating lease. It cannot be a finance lease because not substantially covering all of the economic benefits. It can meet one of the criteria, right of direct to use for 5 years. Right of direct to use means that there is a hospital and they have involved a renting company to rent them ambulance. Now, whenever this hospital requires an ambulance, if this renting company can send any ambulance they own 10 ambulances, and they can send any ambulance out of the 10 they own for use of hospital on demand. Is there any right of use or control by the hospital in this arrangement? Is there any control? or is it simply a service by the renting company to the hospital? There is no leasing arrangement in this. But if the hospital is provided with an ambulance, as per the demand of the hospital, the model, the make, the type, and it cannot be replaced by the supplier. It is controlled by the hospital for movement, and timings are decided by staff. This is a right of use asset. It is being controlled. Substantially, all of the economic benefits will be received by the hospital, and they have the right of directing the use of that asset. In the first case, there is no right of directing, no right of direct to use. So it is not a leasing arrangement. In second scenario, there is a right to direct the use of an asset. So it's not just about controlling, it's who is actually owning the right to direct the use of an asset, who is still able to interfere in it. And if there is any interference in it, then it will not be considered as a right of use asset in control of the management. So when deciding whether this is meeting the criteria of right of use or not, we need to see whether who is controlling the asset, whether substantially all of the economic benefits are being received by the party which is owning this right of use asset, whether they have the right to direct the use. If it is still with the supplier, then it will not be considered a lease. It will not be considered a right of use asset. Clear? Now, what about sale and leaseback transactions?
Amit, just one thing. If we can go back to the example of that hospital that has the right to use and direct the use of the ambulance. But what if like they make further use of the ambulance, not just for the patient, for the equipment, for the other things as well? So these, if the permit does not allow, so then in case the hospital does not have all the rights.
Can you repeat, like if
they make further use of the ambulance?
Further use in the sense that it is further use can be that it is of such specialized nature that only a hospital can use it. Then
And for the patients only, right?
yeah, then also it will be considered ROU asset in control of hospital. They had got it prepared or they got it customized from the supplier. See, supplier is supplying ambulances, but this ambulance is specifically demanded by the hospital that we want this kind of an ambulance. We want these facilities in the ambulance. So this cannot be used by any other hospital because they have demanded this specifically for them. It is of a specialized nature. Then we can say that hospital is able to control. Hospital is able to direct the use means they are able to tell when this ambulance will move out of the hospital, when they want it at the hospital premises, when they do not want it at the hospital premises, it can be decided by the staff of the hospital. But if we are simply getting a service from a supplier that whenever we need an ambulance, we simply need to call them and they'll send any ambulance. So in that scenario, the ambulance is not in our control. We'll be able to receive this facility only on demand. And we do not even know which ambulance will come for providing the service. So there is a difference between the two.